Friday, January 9, 2026. This is a date that history books might one day record as the moment the illusion of market stability finally shattered. While retail investors were distracted by New Year headlines, a $14 billion trapdoor was quietly pulled open beneath the precious metals market. We aren't talking about a rumor or a speculative dip. We are talking about a mandatory contractual execution. Institutional banks are being forced to dump massive positions in gold and silver within a brutal 5-day window. If you've been watching silver hover near $80 and wondered why it hasn't rocketed to $100 despite the global chaos, you are looking at the reason. Tonight, we analyze the Bloomberg Commodity Index rebalancing, a technical mechanism being used as a weapon of mass liquidation. Is this a collapse, or is it the ultimate shakeout before the greatest wealth transfer in modern history? We are stripping away the propaganda to show you exactly how the smart money is positioning itself while the public is being led to the slaughter. To understand the magnitude of this event, we have to look at the mechanics of the BCOM, the Bloomberg Commodity Index. This isn't about sentiment, it's about math. Because silver and gold performed so exceptionally well throughout 2025, these deep, massive index funds now find themselves overweight. The rules are cold and inflexible. By contract, they must rebalance. They aren't selling because they think silver is overvalued. They are selling because their bylaws demand it. The numbers are staggering. We are witnessing the forced sale of $7.1 billion in silver and $7 billion in gold. This represents approximately 17% of the entire open interest in the March silver futures contracts. To put that in perspective, imagine trying to force nearly 1/5 of all active trading volume through a single exit door in just 5 trading sessions. Scotiabank's internal analysis, which has been circulating among institutional desks, confirms the pressure. This is what we call structural selling. It doesn't care about support levels, it doesn't care about your stop losses, and it doesn't care about the news. It is a mathematical sledgehammer hitting the market at precisely the moment when physical supply has never been tighter. The fiction of the spot price. The most critical thing for any investor to understand right now is the total divergence between the paper market and the physical market. When you see silver quoted at $78 an ounce on your screen, you are looking at a digital derivative, a promise that may never be fulfilled. In the physical world, the story is a nightmare for the bears. Major bullion dealers across North America are already reporting empty shelves. 100-ounce bars that used to ship in 48 hours are now on pre-sale for mid-February. Premiums have exploded to nearly 10% above the spot price. What happens when $14 billion of paper selling hits the market this Friday? The spot price might drop to $70, but the physical price will likely stay at $80 or higher as dealers hike premiums to manage their vanishing inventory. We are seeing a decoupling where the digital price becomes a fiction used to scare retail traders, while the physical metal becomes a trophy for those who can afford the gate fee. Geopolitical fuel on the fire. This liquidation isn't happening in a vacuum. On January 8th, the U.S. Coast Guard seized a Russian-flagged oil tanker. Iran is issuing warnings of preemptive strikes. The rules-based order is effectively dead. When major powers begin seizing assets on the high seas, the demand for non-sovereign stores of value, assets that cannot be frozen or canceled by a central bank, becomes insatiable. Silver and gold are the only assets that exist outside this weaponized financial system. Look at the oil-to-silver ratio. Crude oil is trading at $56 a barrel, while silver is at $78. It is historically rare for an ounce of silver to cost more than a barrel of oil. This anomaly tells us one of two things. Either oil is about to skyrocket due to Middle Eastern conflict, or silver is pricing in a total monetary collapse. In both scenarios, the paper sell-off on Friday is nothing more than a temporary distraction from a systemic fire. The empire of debt, the U.S. national debt, has crossed $38.5 trillion. The engine of the American economy is stalling, with job openings at their lowest level in a year. The Federal Reserve is trapped. They can either raise rates and bankrupt the government, or they can print money to monetize the debt. History shows they always choose the printing press. With Jerome Powell's term ending in May 2026, the administration is already vetting doves who will subordinate inflation concerns to keep the debt-fueled machine running. Silver at $78 is actually cheap when you adjust for the M2 money supply growth. If silver were to match its 1,980 inflation-adjusted peak, it wouldn't be $80, it would be over $700, while Wall Street trades paper contracts. The industrial world is facing a physical deficit that cannot be rebalanced away. Silver demand for solar panels and AI data center infrastructure is inelastic. You cannot build a high-speed processor or a high-efficiency solar grid without silver. There are no substitutes, even in a recession. These are political and technological mandates that transcend economic cycles. China understands this. While Western institutions are dumping paper silver to satisfy index requirements, Eastern powers are quietly absorbing every physical ounce they can find. They aren't looking at the 5-day chart. They are looking at the 50-year resource war. By allowing the paper price to be suppressed this Friday, the U.S. is essentially subsidizing the industrial rise of its greatest rivals. For the chartists among us, the noise of this Friday's liquidation should not obscure the signal of the 40-year breakout. Silver has spent 4 decades forming a massive cup-and-handle pattern. It broke the $50 resistance in 2024 and never looked back. In technical analysis, the longer the base, the higher the space. A 40-year consolidation doesn't end with a move to $80, it ends with a move that adds zeros to the price tag. We saw silver consolidate at $50 before jumping to $83. We are now seeing another consolidation. This Friday's BCOM Rebalancing is a false break or a shakeout, a move designed to trigger algorithmic selling and flush out leverage before the next leg higher. The gold-to-silver ratio has already dropped from 1:0 to 1 down to 6:0 to 1. If this ratio returns to its historical average of 1:5 to 1, silver has exponentially more room to run than any other asset class. Friday is not a crisis for the long-term holder. It is a clearance sale. The question you have to ask yourself isn't whether silver will go down this Friday. It very well might. The question is, if the price drops but you can't actually buy any physical metal at that price, did the price really go down? We are entering a phase where the spot price is becoming a hallucination. The $4 billion paper liquidation is the smart money trying to trick you into trading your physical ounces for their depreciating dollars, precisely at the moment those dollars are losing their last bit of international credibility. Successful investors in this environment are not trading price movements. They are accumulating ounces. They understand that in a system saturated with $38 trillion of debt and escalating global warfare, the only thing that matters is what you can hold in your hand. Don't let a 5-day technical event blind you to a 5-decade structural shift. The clock is ticking toward Friday. The paper will be dumped, the algorithms will fire, and the media will scream crash. But for those who can see through the smoke, Friday is the warning shot before the real explosion. Are you holding the asset or are you holding the promise? Choose wisely, because by next week, the exit may be closed forever. What is your move for this Friday? Are you buying the dip, or are you watching from the sidelines as the physical market disappears? Let us know in the comments below. We'll be watching the tape. Stay sharp, stay informed, and we will see you on the other side of the liquidation.
Feast your eyes on the artificial opulence of Wall Street. If you only look at the flashing green on the ticker tapes, you'd swear we've entered a new golden age. U.S. stock indices are smashing through all-time highs, fueled by an insatiable AI frenzy. The masses out there are hypnotized. They believe that silicon chips and black box algorithms are the keys to an era of infinite prosperity. But look closer. That's just a polished veneer on a ship with a gaping hole in its hull. Step with me into the vacuum zone behind that velvet curtain. Do you even know what actually happened on October 23, 2025? While the world was distracted, obsessed with the launch of ChatGPT 6 and the latest metaverse vaporware, U.S. national debt silently breached the $38 trillion mark, a staggering, grotesque figure, an albatross of $500,000 hanging around the neck of every single American under the age of 18. Here lies the paradox. Why, in an economy heralded as the strongest in history, did the U.S. government face a paralyzing, months-long shutdown at the end of 2025? Why, while the Fed has pinned interest rates at record highs to suffocate inflation, has the price of gold refused to collapse? According to every textbook rule, high interest rates are supposed to be lethal poison for non-yielding assets like gold, but reality has just dealt a death blow to that theory. Gold has marched relentlessly toward the $4,500 threshold, while silver, often dismissed as the poor man's gold, has shattered every law of financial physics to strike $70. The answer to this madness cannot be found in Washington, nor in the hollow, rehearsed speeches of the Fed. It lies in an iron hand silently pulling the firewood from beneath the cauldron in the East. While the retail crowd is being lulled to sleep by phantom GDP growth numbers, the smart money is hearing the bone-chilling cracks in the foundation of the system. China is executing a maneuver they haven't dared to attempt in 2 decades. They aren't just quietly dumping U.S. debt to record lows, below $690 billion. They are fortifying a secret gold fortress. Internal investigative reports and forensic analysis of global flows suggest the truth is far darker. Beijing's actual gold reserves aren't the 2,300 tons they officially claim. Our data indicates it has likely surged past 5,000 tons. They're preparing for a net zero scenario for the US dollar. This is no longer a forecast. This is an investigation into the collapse of an old world order and the violent birth of a monetary system anchored in hard assets. Are you holding paper promises, or do you own the truth? Follow the money. Trace the flow to see the truth. According to the latest data we've unmasked from the U.S. Treasury, China has slashed its holdings of U.S. Treasuries to below $690 billion, the lowest level since the 2008 financial crisis. Remember, they once held over $1.3 trillion. They are dumping, but it's not because they lack liquidity. The actions of the People's Bank of China, PBOC, represent a global forensic analysis campaign. They have purchased gold for 13 consecutive months, but that is just the surface figure. Our deep cover sources indicate that China is constructing a gold fortress with actual reserves potentially exceeding 5,000 tons, double the officially reported figures. Why do they need so much gold? Because they recognize that U.S. debt is a necrotic wound. When debt exceeds the ability to repay, the U.S. has only 2 choices: print money to trigger hyperinflation, burning the currency's value, or default. Both scenarios lead to a single inevitable conclusion: the reign of hard assets. Meanwhile, Japan, the storm petrel of the U.S. alliance, is starting to disintegrate. The collapse of the yen, despite rising rates, is merely the first domino. Tokyo is being forced to choose: save its currency by dumping U.S. treasuries, or go down with the USD ship. When Japan offloads and China delivers the follow-up punch by liquidating their remaining $690 billion, the ice wall of the U.S. credit system will melt in hours.
Now is the time to connect the dots that the mainstream media is too terrified to mention. Have you ever wondered why silver has skyrocketed over 140% in the past year? Why is silver outrunning gold? This is the logical leap you must understand. Silver is not just currency, it is the blood of green technology in defense. China dominates the global supply chain for solar panels and electric vehicles, the 2 most silver-hungry industries on Earth. By controlling the physical supply of silver while simultaneously dumping U.S. debt, Beijing is executing a masterclass liquidity squeeze. They are draining silver from U.S. COMEX vaults and shipping it to the Shanghai Gold Exchange. When the U.S. realizes they no longer have enough silver to manufacture missiles or solar grids, they will be forced to buy it back at extortionate prices using the very dollars that are losing value. This is a war without a single shot fired. They, the U.S., are trying to maintain their status by printing promises. We, China, and smart central banks are silently migrating to a system settled in gold and silver. The physical silver shortage is unavoidable. When gold and silver ETFs realize that the metal in the vaults cannot meet the demand for physical settlement, we will witness a technical default on paper exchanges. That is the moment gold won't just hit $4,500, it will aim for $5,000 in 2026.
Investors, we are standing at the climax of a financial drama decades in the making. The spring of U.S. national debt has been compressed to its breaking point. At $38 trillion, every Fed rate hike is like a knife wound to the heart of the Treasury. China has spotted this jugular vein. They are waiting for the perfect moment, a black swan, be it a new geopolitical conflict or a banking collapse in Japan, to deliver the final blow to the U.S. dollar. When this spring uncoils, capital will flee from anything labeled as a paper asset. Stocks may still rise in nominal terms, but their purchasing power will be pulverized by runaway inflation. Only those holding God's money, gold and silver, will remain standing amidst the rubble. The final warning: do not sell early. Do not let the short-term turbulence created by whales shake you out of your position. $4,500 gold and $70 silver are just the warm-up act. 2025 is the year of the crash. 2026 will be the year the world reprices everything. Remember, they want you to believe in the numbers on your screen. We believe in what we can hold in our hands. If you want to continue following the deepest, rawest investigations into the flow of money, hit subscribe to receive the earliest alerts from us. You are witnessing the impossible, a paradox that defies the very laws of financial physics. Last night, Washington dropped a bombshell. U.S. GDP hit 4.3%, the strongest growth in 2 years. According to every mainstream economic textbook, this should have been the death blow for gold. The dollar should have soared to the heavens, and gold should have been crushed under the iron heel of rising interest rates. And for exactly 15 minutes, the script played out perfectly. Gold went into a free fall, shedding $60 in a guillotine move that wiped out thousands of retail buy orders. The crowd fled in a panic, convinced that the $4,500 bubble had finally burst. But look closer at the tape. Why, at that exact war zone of 4,500, did a massive, silent, and cold-blooded buying force swallow every single sell order? Why, when the GDP numbers looked their brightest, did gold stage a violent reversal, piercing through the 4,500 ceiling like an unstoppable arrow? The answer does not lie in Washington. It lies in Beijing. Last night, while the world was hypnotized by America's hollow GDP figures, the Eastern Dragon was executing a move of total subversion. Welcome to this special investigative report by News Finance. I am your guide through the shadows of the global money flow. Let me perform an autopsy on that 4.3% GDP figure for you, so you can see the rot inside. As a hedge fund manager, I don't look at headlines. I look at the internal organs of the report. The reality is grim. American consumer confidence is crumbling. Durable goods orders, the very backbone of industrial production, have plummeted by 2.2%. So why is the GDP so high? Because the U.S. government is spending money like there is no tomorrow just to maintain a veneer of prosperity. This isn't growth, it is a forced blood transfusion from public debt. But while the retail crowd was being distracted by these synthetic numbers, smart money was tracking a different ghost, the People's Bank of China. Satellite data and customs reports reveal a chilling truth. China has been stealthily accumulating gold for 13 consecutive months. Even as gold hit all-time highs, they did not stop. Why? Because Beijing has looked through the smoke and mirrors of America's $36 trillion debt trap. Follow the money. Last night, when gold dipped into the 4450 zone, massive iceberg orders were triggered. These were not the orders of retail traders. These were sovereign reserve orders. China is trading paper dollars for physical gold bullion. They are building a great wall of gold to shield their economy before the American financial storm makes landfall. And China isn't just buying gold, they are executing a scorched earth strategy. In the last 48 hours alone, they dumped over $11 billion in U.S. Treasury bonds. This is a mass exodus. When your largest creditor starts throwing your IOU notes into the trash, you know exactly what is coming next. Connect the dots, and you will see a terrifying picture of the collapse of the old world order. In the West, Donald Trump is creating an unprecedented political earthquake. He has openly challenged the Federal Reserve, the institution once considered the holy sanctuary of currency independence. His message is blunt: either pivot and cut rates to save the economy, or step down. When the Fed loses its independence, the U.S. dollar is no longer a safe haven. It becomes a political pawn, and that is the spark for gold's fury. In the East, Beijing is weaponizing this instability. They are leading the BRICS nations to create a new settlement system. Their strategy is simple: the weaponization of gold. They know that U.S. public debt has passed the point of no return. The interest payments on U.S. debt now exceed the entire national defense budget. This is a spring compressed by desperation. China is standing on the other side of the battlefield, quietly gathering every ounce of gold possible for the moment that spring finally snaps. Imagine this: when the dollar is politicized, when U.S. debt explodes, and when China introduces a currency backed by gold, the $4,500 mark today will look like a quaint starting point. We are in a war without bullets, where the weapons are not nuclear missiles, but 24-karat gold bars. They, the manipulators, want you to believe the dollar is still strong, so they can exit their positions safely. But we, the smart investors, must see the current flowing beneath the surface.
The $4,500 barrier has been conquered. But do not misunderstand me. This is not the time to celebrate or take early profits. Technically, we have entered a vacuum zone. There is no more historical resistance. Above us is an open sky. When the algorithms of the major banks fully recognize the structural collapse of the dollar, a mass buy-stop sequence will be triggered. This will be a short squeeze of biblical proportions, incinerating every short seller on the planet in an instant. The next target, 4,600, 5,000, it is no longer science fiction. With China aggressively increasing its position and Washington's policies accelerating the erosion of trust in the dollar, we are entering a new financial epoch, an era where gold is no longer jewelry, but the only life jacket on the Titanic of fiat money. Here is my final warning to you. Do not be the person standing on the tracks when the high-speed train arrives. Last night, thousands lost everything because they believed in that 4.3% GDP lie. They sold their gold at $44.50, and now they are forced to buy it back at $45.20 with bitter regret. Do not sell the insurance of your life for a few minor tremors. Follow the footprints of the Eastern Dragon and the smartest money in the world. The market is never wrong. Only those who misread it pay the price. The great game has only just begun. Which side will you choose? The side of paper notes losing their soul, or the side of the eternal metal? Don't forget to subscribe and turn on notifications, because in the coming days, this battlefield will only get more brutal. I will be here with you, stripping away the masks of Wall Street one by one. I'll see you in the next investigation. Stay sharp and hold your ground in this financial storm.